G'day. Welcome back everyone to another update regarding high-grade copper and US crude. Now the charts are showing that high-grade copper has had a massive spike in the last couple of days and US crude is currently stable with its prices. Stay to the end of the video because even if you're not trading these instruments, I'm going to go through the concepts and rules you should be applying to whatever instrument you intend to trade. We'll include backtesting, which demonstrates how you could have traded using one of two strategies. So don't forget to hit that like and subscribe button to support the channel. Also, before we proceed, if you haven't already, I strongly encourage you to invest 24 minutes of your time and watch this +1 video. Follow the trend with average down. This, I believe, clearly illustrates how to trade with almost any indicator profitably. I use this approach in all my analysis when reviewing instruments, including today's review. Links are in the description below. So first off, in terms of the outlook, copper prices have surged to around $5.69 a pound following President Trump's proposed 50% tariff on copper imports, intensifying global trade tensions. This move is expected to reduce US-bound shipments, particularly from major suppliers like Chile, Canada and Peru. Analysts warn of significant market impacts with potential harm to US manufacturing reliant on imported refined copper. For US crude, the US Energy Information Administration has revised its 2025 oil production forecast down to 13.37 million barrels per day, citing reduced drilling activity amid declining prices and market uncertainties. Despite this, Brent crude is now expected to average $68.89 per barrel in 2025, up from $65.97 due to geopolitical risks linked to Iran's nuclear program. Overall, both commodities are experiencing significant price movements driven by geopolitical developments and policy decisions leading to increased market volatility. So US crude, we always look at the long-term trends. US crude on the monthly is showing still a bearish momentum with both the price and the CCI below the respective moving averages. It's making a bit of a bounce here, but not bullish yet, so predominantly bearish on the monthly. On the weekly, it's a fresh breakout to the upside. You can see the price is freshly broken to the upside, as well as the CCI, but notice the moving averages are still in a downtrend. I'd like to see them curve up to be more encouraging. Sometimes they can actually break up and be a bit of a false break like it did back here, but overall I'd like to see them break up and trade with that movement to the upside on both the moving averages, on both the CCI and the price in a bullish mode. But at the moment, cautiously bullish. On the daily, likewise, the CCI is broken up through the moving averages, but the price is still below the moving averages, giving us a neutral positioning at the moment. Notice, however, we've got this fair value gap up here, and very likely we're going to see the prices move higher. This may not happen overnight. It could take a few days or even weeks to play out. But we expect the subsequent prices in the coming period to cover this range, which is a fair value gap. You can see back here, these are other fair value gaps. This has been covered. This one down here hasn't been touched yet. So again, very long term, we might see the price retrace back towards these support levels. Now, if we go to the intraday chart, we look at the 1 hour chart, even if you're trading on the daily, to see if there's any micro moves. And what we're looking for is any divergence. You can see here that we've actually got a divergence currently building. Got up to that point, you had higher highs on the price. To there, you got lower highs on the CCI. That was your first instance. Now the price made a new high there, so that bullish movement still looks that way on the price. But again, notice that peak on the CCI is still not higher than that previous peak. So declining peaks or highs on the CCI versus higher highs on the price. That's a bearish divergence. So we may likely see a down pull to the downside in the coming hours or even days. Back here we had a bullish divergence, higher lows versus lower lows on the price. That actually bounced, went sideways for a while, and it finally broke through here actually and hit that minimum target range. That minimum target range is a 23-38% range. So if I drew a Fibonacci, that's at 23-38% minimum range. So again, it doesn't always hit it straight away. In this case, it took a while. It took a few days, actually, almost a month, to reach that period. It just actually broken around about the 31% at the moment with that peak there. Now, in terms of back testing, by the way, we had these periods back here. We had a bearish divergence, 2 instances, very similar to what we've got at the moment. And the first one pulled back slightly, but the price kept rising until that second peak, and it then eventually fell off quite strongly. So, and then in terms of the back test, we go to the 1 hour back testing charts. And what I've done back here, I've started, if you're trading on the 1 hour, trade in the direction of the daily. So I've got here the CCI is above the moving average, and so is the price on the daily chart. And that's where you start the back test here, or where I've started the back test with a stop loss approach on the top chart here, the profitability. And this profitability shows the average down approach. Now you'll notice you just let it run, and at the very latest you close it out when that CCI touches that moving average range. And that period there would have been the 22nd of May, so about this period back here. And also you're given this warning as well with a bearish divergence, lower highs on the CCI versus higher highs on the price. And the price did actually fall off during that period. Again, you would have gone long again in conjunction with the daily, and it went sideways there for a while, but eventually you would have going long from that point. At the very latest, you would have closed it out at that point there when the CCI touched the moving average band on the daily. However, I like to read the 1 hour charts. Let me just get rid of that divergence, or that Fibonacci. So reading this bearish divergence back here, and again, this is covered in that follow your trend video I just outlined in the start of the video. You want to take close out your long positions whenever you see these bearish divergence starting to play. So firstly, you would have probably got out at that one after that little first bearish divergence, got out somewhere there near the high, but at the very latest you should have got out at that point there on the hourly chart before it finally collapsed. So very similar to what's happening today. It doesn't mean the price is going to collapse, but it may do so, we don't know. But if you hadn't already got out at that point there, you probably want to start getting out sometime around now if you're going long. So here we have high-grade copper. Now on the monthly chart, the CCI is well above the moving average, and so is the price. In fact, the price this last couple of days has actually spiked up quite strongly. So bullish momentum, very strong bullish momentum on the monthly. There was a bearish divergence back here, and that broke down, hit our target range. I've highlighted it there with the blue rectangle. On the weekly, also bullish momentum. It's broken through that previous resistance. The resistance at 53.953. But you'll notice down here we've got this fair value gap, and that's been 50% filled. So just be cautious of that. We might see a pullback to some in the coming. Could actually take months or even years sometimes, depending on how high this goes. And on the daily as well, we had a massive spike the last couple of days. Now you'll notice as well, this candle's still in motion, is still in play. But if we were to draw a fair value gap, and again, it's too early to draw it. I'm just going to demonstrate how the fair value gap works. We take it from the high of the previous day. If we're measuring this middle candle, we take the candle before from the high of the previous day to the low of the preceding day, the day after. And that would be the fair value gap. Now, again, this candle today could actually collapse and come down this way, but it may not. And if it stays higher than that point there, then we're going to consider that as a fair value gap. I'll leave it marked there as a moment at the moment to see where it ends up finishing. But at the moment, that's potentially where a fair value gap will exist. Now, if we go to the 1 hour chart, before I go to the back test, let me just quickly show you the 1 hour chart without all the back testing. So what we're looking for now as well is a fair value gap. We had a divergence. We had a bearish divergence here. You can see there we had this higher highs on the price versus lower highs on the CCI, and that actually pulled back. And the way to measure that again, using the Fibonacci retrace, go back to that significant low, and we draw a 23-38% target range in that period there. And you can see there it broke right down to the almost to the 50% level. It broke right through that 23-38% and landed around the 50% level before bouncing strongly. So again, when you see these bearish divergence, if you're going long during this period, that's where you would have probably taken closed out your position, because we don't know what's going to happen after that. This could have actually, the price could have dumped. We didn't know it was going to do this at this point. Now, if you're trading on the hourly, this is the hourly chart. To get back into the long positions, you probably could have entered a trade somewhere during this period when the CCI was above the moving average, and so was the price. Now, in this case, it gave you a false break to the downside. Maybe a lot of traders would have been stopped out on that one. But if you follow my average down approach, as long as it doesn't break strongly to the downside there, you can actually hold on to it, and you could have ridden that higher. Now, in this case, again, you can see there on the hourly, you've got a fair value gap there. And this is independent from the daily, by the way. So even though the daily, I've marked that one there, that's a higher one you can see there. This is actually a different period on the 1 hour chart. Also notice back here, we've got another smaller fair value gap. So at the very least, we're going to see a price breakdown at that level there in the coming hours, and possibly even into this area. You can see there the CCI is broken down into that moving average range, giving us a neutral positioning, even though the price is fairly bullish at the moment. So I'll also notice as well, if you're following the divergence, we had our bullish divergence here, and as soon as you see a lower low on the price and a higher low on the CCI, that's a strong indication it's going to bounce. And if you had got in sometime, probably you would have been very tight to get into it. But if not that candle, you would have got in probably that one. That would have been near the high there. So you might have missed a boat on that one. That was a pretty quick rise. But again, that was a bullish divergence. And you can see there, break right through. If I draw a Fibonacci in that range, you break right through the 100% retrace level. Now, if we go to the back test, I've started the back test here and about the going back here and about the 23rd of May for the stop loss approach and the average down approach. And the stop loss approach is actually about break even, and the average down approach, again, paying attention to all these bearish divergence and getting out of the trades. And that was the last one you would have got out of at that point there before going long again. So if you're trading according to that, if you let it run through the whole period, you would have generated about $29,000 on that trade from about the 23rd of May. But again, paying attention to the bearish divergence and getting out of the trades where you see bearish divergence. So again, if you're new to trading, we're now including the video series Pete's Investing Plus One as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, subscribe at least on the free trial to my Patreon page, where I publish weekly bullish shares across regions of the world's markets. Thanks, and talk to you in our next video.